Imagine this. It's a sweltering August afternoon in 2025. Cameras are rolling, microphones are hot, and Donald Trump steps up to the podium. His tone is urgent, his words unmistakable. We need China to quadruple its soybean purchases from the United States, now. Not a polite ask, not a negotiation, a demand. Within minutes, soybean futures in Chicago spike more than 2%. Traders in the pits and behind computer screens start clicking like mad, betting that maybe, just maybe, this shock announcement means a flood of Chinese buying is about to hit the market. The talking heads on cable news are already spinning it as a bold economic play. But here's what they didn't say. Beijing's silence was louder than any press conference, because while Trump was delivering that soundbite, Chinese state buyers were already finalizing contracts for millions of tons of Brazilian soybeans, enough to fill their feed mills through the critical autumn months. The ink was still drying on deals that gave Brazil more than half of China's September and October imports. Why bypass America? Even with US soybeans priced roughly $40 per ton cheaper than Brazil's, those tariffs from the 2018 trade war still hang over the market like a storm cloud. And if there's one thing Beijing doesn't gamble on, it's food security. No tariff relief means no rush back to American suppliers, no matter how desperate the demand sounds. This isn't just a headline about soybeans. It's the latest chapter in a 7-year story about how the United States lost its grip on the world's biggest agricultural customer, and how even a quadruple sales pitch might not be enough to win it back. To understand why Trump's quadruple demand feels more like a Hail Mary than a winning play, we have to rewind to 2018, the year soybeans became the unlikely frontline weapon in the US-China trade war. Back then, American farmers shipped roughly 1 out of every 3 bushels of soybeans to China. In value terms, it was a $12 to $14 billion annual trade lifeline for rural America. But when Washington slapped tariffs on hundreds of billions of dollars worth of Chinese goods, Beijing retaliated, putting a 25% duty on US soybeans almost overnight. The effect was immediate. Chinese importers, who had long relied on the Gulf ports of Louisiana and the river system of the Midwest, began turning south to Brazil and Argentina. Brazil, in particular, seized the moment. They didn't just fill the gap, they expanded acreage, invested in logistics, and by 2020 had cemented themselves as China's primary supplier. Then came the so-called Phase 1 trade deal in January 2020. On paper, China agreed to buy an additional $200 billion worth of US goods, including a $32 billion boost for farm products over 2 years. In practice, Beijing never hit the targets. By 2021, American soybean sales to China were still far below pre-2018 levels, while Brazil kept smashing export records. Fast forward to 2024. China imported a record 105 million metric tons of soybeans, over 70% of them from Brazil. The US share, just 22.1 million tons, worth about $12 billion. In other words, the once-in-a-generation customer had been reduced to buying roughly a quarter of what it used to. And here's the kicker. 2025 started no differently. In the first 7 months, China bought more than 61 million tons of soybeans. Again, over 2/3 from Brazil. The only real openings for the US come in the narrow September to January window, after Brazil's supplies start to run thin. And now, even that window is closing because Chinese state buyers have pre-booked massive cargoes from Brazil through October. So when Trump tells Beijing to quadruple their orders, he's not just fighting against a political standoff. He's fighting against a supply chain that's already been rewired. A supply chain that was reshaped, quite literally, while he was in the White House the first time. Let's strip away the politics for a moment and look at the hard numbers, because they tell a story that's every bit as brutal as the headlines. According to the USDA's August 2025 WASDE report, US farmers are expected to harvest about 4.3 billion bushels of soybeans in the 2025/2026 season. That's solid, but not record-breaking. What is record-breaking is how much of that crop America now processes domestically. U.S. soybean crush, the act of turning beans into soybean oil and meal, has climbed to an all-time high of 2.49 to 2.54 billion bushels. That's up from about 2.23 billion just 2 years ago, driven largely by the boom in renewable diesel. On paper, that's great news for domestic demand. But here's the catch. The more we crush at home, the fewer beans we have left to export. And exports are where the US used to dominate, until Brazil rewrote the rules. Brazil's National Crop Agency, CONAB, now pegs their soybean exports for 2025 at between 105 and 112 million metric tons, enough to dwarf the US by tens of millions of tons. And they're doing it with ruthless efficiency. Over the last decade, Brazil has expanded its soybean acreage, improved yields, and crucially, built out new ports and rail lines in the north that shave days off the voyage to China. Then there's the pricing edge. Thanks to a weaker Brazilian real, Brazilian beans remain competitive even when US prices dip. In many cases, Brazilian exporters can undercut US Gulf prices and still make a profit. And logistics? The Mississippi River, a critical artery for US soybean exports, has been plagued by low water levels in recent years. In both 2022 and 2023, barge traffic slowed to a crawl, freight rates spiked, and reliability took a hit. Chinese buyers noticed. In global commodity trade, consistency is king, and Brazil's shipping performance has made them a safer bet. Meanwhile, China has been locking in its security of supply well ahead of time. By mid-August 2025, state buyers had already secured about 8 million tons for September delivery and another 4 million for October from Brazil. That's more than half their expected demand for those months, which means that even if they wanted to, Beijing would have to rip up existing contracts to meet Trump's quadruple target. That's not how international commodity deals work. The USDA data, the shipping manifests, and the price charts all point in the same direction. America is no longer the default supplier to China. Brazil is. And unless there's a major geopolitical reset, one that removes tariffs, restores trust, and solves the logistics headaches, the US will remain in second place, no matter how much political theater is on display. Every trade shift creates winners and losers, and the soybean saga of 2025 is no exception. The scoreboard is pretty clear. Brazilian farmers and exporters are enjoying a golden age. Not only are they shipping record volumes, but they're also commanding the kind of long-term contracts that guarantee income stability. The Brazilian real's weakness acts like a built-in subsidy, making their beans cheaper on the world market without cutting into margins. On top of that, their government has leaned into agricultural infrastructure, new rail lines from Mato Grosso to northern ports, dredging projects to deepen shipping channels, and private investment in high-capacity grain terminals. All of it shaves days off delivery times to China, and in commodity markets, days matter. US crush plants and renewable diesel producers are also cashing in. The surge in domestic processing means more soybean oil for the booming renewable diesel sector, which has been fueled by state and federal incentives. CoBank and industry groups project US crush capacity could rise from about 2.55 billion bushels today to nearly 2.78 billion before 2030. For processors, this is a win. Steady supply, growing demand, and less reliance on unpredictable export markets. Global grain traders like Cargill, ADM, and Bunge are playing both sides. They have assets in Brazil and the US, so they profit whether the soybeans sail from the port of Santos or the port of New Orleans. Their flexibility is their advantage. American farmers focused on exports, especially in the Midwest, are feeling the squeeze. For decades, China was their most important customer, soaking up a third of their crop. Now, that pipeline has shrunk, and while domestic crush demand is a partial cushion, not every farmer benefits equally. The ones far from crush plants are still dependent on exports, and those sales are harder to come by. US river logistics and Gulf ports have also lost ground. Repeated low water events on the Mississippi have driven up shipping costs and hurt reliability. Once buyers get used to a steadier supply elsewhere, it's hard to win them back. Small and mid-sized farms with tight cash flow are the most vulnerable. In 2019, farm bankruptcies, Chapter 12 filings, hit a decade high at 599 cases. After pandemic-era relief, the numbers dropped for a few years, but in 2024, they jumped 55% to 216 filings. With interest rates still high, input costs elevated, and export opportunities narrowing, those numbers could climb again if market access continues to shrink. In short, Brazil's farmers are thriving, US processors are adapting, global traders are hedging, but America's export-focused farms are losing the very market that once sustained them. The road ahead for US soybeans now forks into a few possible directions, and each carries its own consequences for farmers, traders, and the political theater surrounding them. In the best-case short-term outcome, Washington and Beijing managed to reach a partial thaw by late September. It wouldn't be a sweeping trade peace, but rather a narrow carve-out, something like a temporary or selective suspension of the tariffs that have hung over the market since 2018. That kind of move wouldn't undo Brazil's autumn contracts, but it could prompt China to layer in a few extra US cargoes for delivery later in the year, perhaps in November through January. Prices on the Chicago Board of Trade would likely pop on the news, a short, sharp rally rather than a prolonged boom, while exporters in the Gulf and Pacific Northwest would scramble to piece together shipments. The political headlines would look triumphant, even if the actual tonnage remained capped by deals already inked with South America. A more middling path is one where nothing much changes until next year. In this scenario, tariffs stay in place through the fourth quarter, and Chinese buyers continue sourcing the bulk of their needs from Brazil, dipping into the US market only when the price spread briefly turns in America's favor. Futures would drift sideways, moving more on weather scares and USDA revisions than on trade news. The domestic crush would keep swallowing a bigger share of the crop. Meal would flow steadily to domestic feed markets and to Mexico, and soybean oil would remain at the mercy of shifting renewable diesel policy. Farmers near large crush plants might stay afloat. Those farther out, still tethered to the export pipeline, would find life harder. It's a slow bleed, a survivable one, but a path that cements Brazil's dominance for another marketing year. The darkest turn would be a full breakdown in talks, a replay of the trade war's ugliest moments. Rhetoric hardens, new measures are thrown on the table, inspections tighten, and Beijing doubles down on Brazil while expanding ties with Argentina and other suppliers. In that world, US soybeans rally briefly on fear before sinking under the weight of lost demand. Basis weakens in export regions, lenders start tightening terms, and whispers of a new farm aid program begin to circulate in Washington. It's not the end of the soybean market, but it is the end of the US-China relationship as we once knew it, at least for this commodity. Breaking free from this bind requires more than press conferences. It demands the removal of the tariff overhang in a way that lasts, measured not in days or weeks, but in seasons. Without that, Chinese state buyers will continue to plan as though the US is a risky, politically unstable source, no matter how competitive the price. It also means proving year after year that America can deliver its crop reliably. That requires dredging the Mississippi to maintain draft depths, keeping locks and dams in working order, and ensuring rail lines to the Pacific Northwest run with the speed and consistency global buyers demand. And finally, it calls for embracing the domestic crush strategy with intention, not as a consolation prize. If China won't buy the beans, there's value in selling the meal and the oil to the parts of the world that will, and building that trade into something as dependable as the China flow once was. For farmers and policymakers alike, the message is simple. Treat every tariff headline as a potential pricing event, not a promise of salvation. Plan your sales with protection, watch your freight and basis exposure, and push for policies that favor long-term stability over short-term optics. Winning back the world's biggest buyer isn't about one man's demand for quadruple. It's about rebuilding trust, infrastructure, and a trade relationship strong enough to weather the politics. If that happens, Quadruple stops sounding like a desperate gamble and starts sounding like a credible target. If it doesn't, the crown stays in Brazil, and the US soybean story becomes one of adaptation rather than restoration.